I think it's a market manipulation.
Should these OTC deals supposed to be allowed if these tokens are locked? Why are we even staking them or even trading them?
Basically, Tim sold about 20 to 30 million locked tokens OTC, and with that profit, they bought on the market.
You're not supposed to sell it at all.
This material is for informational purposes only and is not intended to provide accounting, legal, or tax advice, or investment recommendations, or an official statement of Presto or its affiliates.
Hello, it's the Presto Research Podcast. Today, we got another banger episode. We're going to talk about stablecoins and the aka mantra drama. First, we have Peter. He's going to talk about stablecoins, and later, Min about Let's go straight into the topic. So, Peter, you released a report, a research called Unpacking Stablecoins Dual Drivers recently on the 8th of April. And the gist of the article, as I understand it, is that stablecoins are very popular and it's going to grow even more. But I think we need a more detailed breakdown from you. So let's get into it.
Yeah. So stablecoin is it's a funny one because it's no doubt the biggest blockchain application, but yet there's no moon chasing element in this topic. So I guess if you are somebody in the industry just for the sake of looking for the next 10x or 100x, this is not a topic that will interest you. But if you're somebody who approach this industry from the perspective of why blockchain even matters for this world, then I think it's something that you have to take a very close look at. And so that's why I've always been interested in stablecoin for a long time, and I think now is the right time to go a little bit deeper on this topic because this is one of the biggest initiatives of the Trump administration, so it's definitely getting a lot more attention from both in and outside the industry. So I decided to maybe just kind of summarize my thoughts and my findings on how this application is evolving. And it kind of builds upon something that we briefly touched on in our 2025 Outlook report published in December last year. Because in it, one of my prediction is that in 2025, the stablecoin market cap will grow to $300 billion from what was back then $200 billion. And so far, we're on track. But what we kind of talked about in that discussion in that report was that there are two drivers for the stablecoin growth, secular and cyclical. And secular is you can call it structural driver, something that is not affected by a market cycle. So there, not ups and downs or boom or bust cycle of the crypto market. And then cyclical driver is the opposite. So it's the more kind of volatile, boom and bust cycle driven growth. So you see these huge ups and downs over the short term. And both of those are, I think, is essential component of the stable coin industry's growth. So I break it down into these two. So what I didn't do back in the December report was that we just mentioned it and we didn't go into too much detail. In this report, we do that. And what I specifically try to do in this report is actually quantify the rate of growth for both secular and the cyclical driver. And the way I do it is that basically I make some assumptions. For secular growth, I assume that the USDT has a two version, ERC20. Well, it actually has more than two versions, but two big versions, right? The Ethereum version, the ERC20, and the Tron version, TRC20. And I make assumption that the TRC20 is the version that best represents this secular growth trend, because it's Tron is the network that is more suited for just a straightforward payment application because of a low fee, and also it's quite popular in the emerging markets. And also, if you actually see the growth trend of TRC20 version of USDT, it's far more stable than the other versions of USDT or other types of stablecoins. So I use that as kind of as a proxy for the secular growth trend, and then I look at I pick a time period of the last bear market. I think starting from the beginning of 2022 to I think it was the middle of the first quarter of 2024, because that's the period when the on-chain yield spread against the 3-month T-bill was stayed negative, and I take that as an indication that there's no cyclical demand for the stablecoin, because basically what it means is that you don't have any incentive to keep your stablecoins on. You don't have any incentives to keep your US dollars on chain because you get a better short-term yield on the traditional finance market on the off the chain. So that's my basically kind of assumptions on why this period matters to measure the actual rate of growth for the secular demand, and then I kind of extrapolate that to make a kind of the forecast for where the secular demand is going to go within the next 12 months. And then for the cyclical demand, what I do is that I basically also make some assumptions, such as basically other than the secular demand for stablecoins, the remaining demand is basically all very speculative demand, right? So people want to hold stablecoins because that's a more convenient way of speculating on either by that directly going long on coins or doing some DeFi yield farming, and then basically make an assumption that the DeFi became a thing starting from DeFi summer of 2020, which really started in June 15th. That's the time when Compound, if you remember, if you've been around long enough, you'll remember that the Compound token launch was kickstarted the DeFi summer on June 15th of 2020. And from that point on till now is basically the period that you can take as a proxy for DeFi use case growth. So again, I take the stablecoin market cap, I exclude TRC20 USDT component from the entire market cap, and then measure the growth rate, and basically assume that the growth rate will continue for the next 12 months. So what I end up, the numbers that I end up with is that about 7-8% quarter on quarter growth for the secular demand, and then I think it was 20 plus something. Hold on, what was the rate that I came up with? So 17%. Yeah, 17%. Yeah. So 7.9% for the secular growth quarter on quarter, and then 17% for the cyclical growth for DeFi driven demand growth, and then basically make a forecast for where the demand is, where the stablecoin overall growth is going to go, and then it just turns out to be about $300 billion, actually a little bit more than $300 billion. So basically, I've done all these studies to kind of fact check my original forecast, and turns out that it's about right. So but that's basically the gist of this report.
So my question is, where is all this demand actually coming from, right? I think in the article you mentioned that emerging markets, and you have this graphic called the greatest arbitrage in history, showing some countries or regions that have a very high amount of people who are unbanked, and it seems like you are projecting that demand will come from these regions. And anecdotally, like not me, but like secondhand experience, I hear stories from people like Argentinians or like people from Nigeria. They always say they hold Bitcoin, or they love Tether. Apparently, Tron is like the best blockchain in Argentina. So, do you expect like the dollar stablecoin will become even more and more popular in these emerging countries? And if so, do you think like what are the second order effects if stablecoins proliferate into these emerging markets?
Yeah. So there's a great quote from Kyle Samani that I used in the report, is that the US dollar stablecoin is probably the biggest arbitrage opportunity in the human history. And the reason why he says it is because, you know, there are 8 billion people on the planet. And, they all actually, we are lucky enough to live in a country where the financial system is reasonably stable. But that's only not even half of the 8 billion people. It's maybe we part of the 2 billion people maybe that lives in so-called OECD countries where the financial system is relatively stable. The rest don't have that luxury. So they oftentimes don't have a very stable access to banking system. These are so-called unbanked people. Even if they work very hard all their lives, they don't have a very good means to store their wealth. So for these types of people, if you ask them, okay, in what currency or what asset would you like to save your savings? Their answer would be, a lot of cases will be US dollars. Even the Kim Jong-un in North Korea, there you go again. We talk about North Korea again in this podcast. But even Kim Jong-un, although he's like a arch enemy of the US, I bet 80%, 90% of his wealth is probably sitting in US dollars in some Swiss bank account. So that's how US dollar is like. So it is a highly sought after asset and currency, regardless of which jurisdictions you live in. So I think, but the delivering, having an access to US dollar is very, very difficult in many of those emerging markets, either due to the political and regulatory reasons or for technical reasons. So that's where the US dollar stablecoin comes in, because US dollar stablecoin is basically tokenized representation of the US dollars. And once you put it on the blockchain instead of the legacy banking system, it's really easy to send it anywhere, right? To provide an access to those tokenized assets. So that's the beauty of the blockchain, and that's where you find the biggest kind of product market fit between blockchain and the US dollars. Yeah.
So like recently there was a lot of drama in the markets about how the US dollar is losing its denomination, its hegemon in the currency market. And I don't know how that will conclude in the future, but I think we are seeing some signs of like less demand for the US dollar since Trump is doing all these crazy things. Do you think that will affect the stablecoin market, or do you think that stable coins will actually kind of advance the dollar agenda furthermore into the world and kind of counteract to the isolationist policies of the US?
Yeah, so I think Trump is definitely aware of the risk that some of the larger geopolitical rivals can potentially divest their US dollar assets. And so I think he's looking for ways to offset that risk. So US dollar stablecoin is that example of that offset. So okay, these Russia or China can divest it, but there are other people out there, mostly I guess in the emerging markets that are not China or Russia, but wants access to US dollars as a means to put their savings in. And these are not nation states, probably, like these are individuals. So it's all small amount, but if there are so many of them, there are billions of people. So if you add them up, it can be a meaningful offset. And that's why you see that the Tether's the US Treasury holding is so large that it's like a top 20 holders of US Treasury. If Tether was a country, they would be ranking. It'll be a country that's holding a lot more than South Korea, for instance. So I think, that's I think it's not because of this challenge to US dollar hegemony coming from many other countries in this new world order, I think the stablecoin is something that the Trump look at very favorably.
Yeah. Also, Tether being one of the most profitable companies in the world is like open secret. I think people in the industry know this pretty well, but I think people who are not well versed in how like they just hold treasuries and make yield out of it, they don't really understand how this works. So I think this is an interesting topic. So why don't you like explain how Tether works and how they're even more profitable than BlackRock?
Yeah, that's right. So Tether, it's also, there has been a lot of thought about Tether over the years, right? So, but I think we know by now that Tether is probably one of the most important crypto company in the industry, and I would say even more important than Circle, because US dollar it works reasonably well within the US, right? Although US financial system is kind of cranky and all that. I mean, like there's so many other ways of settling payments in the US, PayPal or Venmo or what have you. So having a stablecoin in the US is not going to bring that much added value to the consumers, but it is outside the US that the stablecoin can bring in some significant benefits. And because the Tether operates primarily outside the US, that's why I think that's why Tether can be a really good partner for the US government if they want stablecoin to really grow beyond the US border. And I think what Tether is doing now, they have about 90 people, from what I hear, employees, but they're generating, because their treasury holdings is so big, it's $100 billion or something like that, and they don't have all the interest income generated from treasury holdings is just their profit. So they are probably, in terms of a revenue per employee basis, one of the most profitable company in the world, and they're using those profits. They're investing these profits into building brick by brick the Tether distribution system in emerging markets. So it's a very slow grinding process. But that's what it takes to, I think, spread these real world use cases in the emerging markets. And I think it might not be quick and it might not be a quick way to reap profits, but it's a strategy that I think does not get affected by ups and downs in the market, and something that it's a sustainable. I think it's a slow but very sustainable business model. I think it's worthwhile to just study how Tether does things, and then maybe see if there's anything to learn from if you are somebody who wants to get into the stablecoin industry.
What do you think about the implications of the weaponization of stablecoins? For example, last year we had like some politicians pushing for censoring transactions to certain entities because they thought that stablecoins were being used to fund terrorists like Hamas. So do you think that will become like a problem, or in the future, do you see this as some sort of vector that the US government can utilize to cripple their enemies in some way? For example, if I were the US government and I want to mess with Kim Jong-un and he's holding a bunch of stable coins in a whatever like on-chain environment, then I'll be like, yo, Tether froze his ass. And then, I would be like that. But so that would mean these evil people, I don't know, like these I don't even know how to say this, like axis of evil, these axis of evil type of people would not want to hold stable coins in the future if that is possible. So do you see any implications in that matter?
Yeah, so Tether has already been cooperating with U.S. law enforcement agents for many years, and so there's always they're constantly monitoring the holders of the wallets of the USDT and responding to the request from the U.S. government if they see any suspicious activities or the criminals getting hold of the tethers. So it's nothing new, and it's it's a problem that exists not just in crypto, but also just in regular banking system. The US dollar fiat, even before it became tokenized, was one of the most heavy. It is a way for terrorists to fund their operations in most of the time. So it's not a crypto specific problem, and the fact that the blockchain can trace this fund flow, I think, is always a useful feature for law enforcement agencies. So I think criminals, if they want to use Tether or any other stable coins for their criminal activities, they really have to study. I think they really have to be a smart ones. Otherwise, they'll spill the beans and then can get easily caught.
I think some privacy tech will kind of circumvent with all these on-chain tracking tools. So I'm looking forward for Vitalik for solving these real-world problems for all my North Korean buddies. Yeah. So yeah, that was a good conversation about stablecoins. So I think we want to move on to the second part of this podcast. So recently we had a 90%, maybe 99%, like a huge drop on this certain token called OHM. It's a token issued by this RWA L1 chain called Mantra. To be honest, I didn't know what these guys were before the drop. I just knew that the price action was weirdly just too pumpy, and surprise, surprise, it just dumped overnight. So Min wants to cover this topic.
Yeah, I think at this stage, it is really hard to know what really happened. I don't know if it's a single person who did it, or was it a group, or was it a spot selling or perp selling, or was it a collateral that got liquidated? But when you look at the chart, you can kind of tell that something was going on. Like you just said, people really didn't know about Mantra, even though it was top 20 market cap crypto. And Mantra almost, I guess, 10x in 6 months. And I don't necessarily think that Mantra is a scam project, but also there weren't any reason for Mantra to pump like 10x in last 6 months. So, and if you're a person in this industry, that you know that the Mantra was very active in the secondary OTC market. And so yesterday I saw this interview between JP, which is the founder of Mantra, and CoffeeZilla. I think he's like the Zach XPT guy. And what JP said was basically Tim sold about 20 to 30 million lock tokens OTC. And with that profit, they bought on the market. I think it's a market manipulation, but JP said it's support for the token. And I don't know what is true in the crypto industry, but basically something sketchy going on. So I think this kind of lead to the main topic in the article that I wrote 6 months, which is the secondary OTC market. Because if you actually talk with the liquid investors and everyone, the importance of the secondary OTC market is getting way more important. So I guess going over quickly about this piece, basically secondary market is selling and buying the locked tokens because you can't sell it on the market. And if you think who's the sellers, it's pretty much team, foundation, and VCs. Because they couldn't cash out as a locked token, they kind of sell it at 30 to 70% discount. I think I have seen some 80% discount, which is kind of ridiculous. But and if you think who's the buyer, I kind of separated into two. One's hodlers and one's hedgers. If you're actually a long-term believer of that token project, and if you're not trying to sell it in next 1 or 2 years, instead of buying at market, whatever the price is, you can buy it at the secondary OTC market at 50 or 60% discount. So one type of the buyers are people who actually believe in the project long-term. And seconds are hedgers, which are mainly traders, I guess. So because it's selling at 50% discount, one way to profit is you buy through the secondary OTC market. On the other side, you hedge through the part market. So basically, if you buy $1 million OTC, you hedge 1 million on part market, you can profit the spread. And one thing that I want to emphasize is that people think it's kind of free money and it's very easy to do. And kind of blame VCs and said, oh, like VCs engages in this business. But on the other side, if you kind of think crypto market is a market where you could easily 2x, 3x, or 4x, the crypto price could 2x, 3x, 4x. So you have to put enormous collateral. So it's actually a very capital intensive job first. And second is there are lots of different risks. One's, of course, exchange risk. And second is, in a bull market, it doesn't really matter. But if you're in a bear market, the funding fee could turn negative, which means that you have to pay when you short it. And you're actually holding a short position, not just for like a couple of days, but for a year. So imagine if you have to pay 8 hours for a year on the funding fee. It's an enormous, I guess, amount. So it's very actually hard to do this. And also on a VC side, I'm pretty sure there is some kind of regulatory issues that kind of blocks them for doing this. So yeah, that's like the buyer side of the business. So it kind of makes me think, is secondary market actually a good thing or a bad thing for industry? On the one side, of course, you have this unlock period because you want your founders to be aligned. Imagine your founder just selling at day one through OTC market at 50% discount, right? But on the other hand, there are some foundation and ecosystem. One of the OTC transactions that happens a lot is you sell your foundation tokens, which is unlocked, but you lock it again and sell it to investors. So there are different good and bad about this business. So, and also the pricing, the 70% discount and 80% discount, I think implies what's actually going on the altcoin market right now, which means that even with the 70 and 80% discount, there aren't no buyers, which means that after 1 or 2 years, many people expect this altcoins to be down like way more. So it kind of tells about the current market situation as well. And I guess going back to mantra as well, from what I know, from my knowledge, huge amount that I think the first unlock is going to happen, I think, at the end of April. So I think, I'm not 100% sure, but I think I'll call it attacker or seller or whatever, could be front running those OTC deal as well.
But my question is, should these OTC deals supposed to be allowed at first? Because like my perspective is, if these tokens are locked, why are we even staking them or even trading them on OTC? Like you just can't sell it OTC, because that doesn't, like, they're locked for a reason. They're locked because they're supposed to incentivize the team to work until they're unlocked. So if you can just sell it OTC on the first day, like the day of TGE, then what's the point of a lockup? Like, if you just bluff your valuation to like 10 bill and, you know, sell your whatever tokens you have by a 50% discount, that's still a 5 billion token. So in my opinion, I'm like, when I see these OTC deals, I'm like, that's pretty bullshit, because you're not supposed to sell it at all. So what do you think about that?
I agree. So I think I kind of separate it into team, VC, and foundation. I think team shouldn't be allowed, actually. The whole purpose of this vesting and unlock is making the align incentive and make them to work. But if, like what you said, if you can sell in day one, probably, and also day one, in most cases, day one is actually the highest price. So the founders are actually losing incentives to work harder. And so I think the only positive OTC that I could see is, like I said, the unlocked tokens of the foundation, instead of selling at the market, they kind of relock it and then sell it to the VCs or other people. I think that's kind of, I guess, somewhat, foundation still needs to sell because they need some money to operate. So instead of selling at the market, they just kind of lock it and sell it to the investors who actually believe in the projects or so.
Yeah. Well, I'm not really well versed in these type of, OTC market deals, but when I see, like, these screen captures from Telegram that a certain project is selling their tokens on a 50% discount. I'm like, whoa, this means that people who have enough money to buy, let's say, $1 million worth of these tokens are going to have like a pretty asymmetric opportunity to profit from this. So, like you asked earlier, if you think this is a net positive or negative for the industry, but all I see is just really loopholes for people who want to cash out really early. And it is just another way to make the playing field uneven.
And also, one thing that I guess for retail should notice is that this kind of stuff kind of messes up all the unlock schedules, basically. So same with Mantra, even though I don't really have the numbers right now, but the circulating supply that's posted on CMC or CoinGecko, I think is somewhat wrong in a real sense, where I think the real circulating supply was extremely low because they have locked and they have sold it to the investors. So people just look at the supply schedule and they go like, 50% is unlocked. In reality, it is not. So also I have talked to lots of liquid investors these days, and all they really do is figuring out how many OTCs they have done and when those things are getting unlocked.
You mean like for the token, particularly like, let's say if there's a token, they just look at how many OTC deals they have done and when their unlock is, so they can figure out when to long or short that certain token?
Yep. And basically there would be huge unlock. So kind of front running those unlocks.
So knowing when these OTC deals went through and knowing when they unlock would be tremendous alpha for, people who trade right now. Would you say that?
It is. Yeah, it is. And it's basically what liquid investors are actually trying to figure out all day.
Where do we get this information?
So it's very hard for retailers. There are platforms like Styx, Second Lane, which kind of does this, I guess, brokerage services. But it's not for, I guess, retails, and the amount is, of course, like 1 mil, 2 mil plus. So it's very hard. So I think, going back to earlier, I think if we can't really stop those secondary OTC deals, I think one way we could kind of improve is actually team announcing or whatever, somewhat of announcement so that people could know what has been done.
But, I don't think the teams would be incentivized to do so. Why would they announce they're selling their own tokens OTC? That's
true.
Yeah, so there's a cat and mouse game going on here between all the investors and retail, basically, right? So even this vesting schedule, it was implemented with a good intention at the beginning, right? In order to protect retail investors from these early investors from dumping. And at least by disclosing that information, intention was that the retail investors would be able to foresee these potential risks, and then they can make their own judgment based on that. But then these early investors got around that by getting into this more not so transparent OTC arrangement with with the various brokers, and then that way it's not so transparent anymore. They on the blockchain, it may seem like they are not selling, but they actually have sold already, right, synthetically through OTC transactions. So that's another way of kind of, I guess, hiding their kind of early profit taking from the public's view. So there's this. So I think if now then the investors are trying to like uncover that as well, and then try to look for any information on OTC transactions. And I think this kind of thing will probably continue to go on. Like one side is trying to hide their transactions, and the other side is trying to uncover that, what's hidden. So
wouldn't this be a problem in the future if like crypto goes? I mean, I think it's pretty mainstream now. So we're already talking about stablecoin legislation. So if crypto is going to truly become a mainstream thing, then don't you think these type of things should be regulated? Or like these disclosures, they're just totally they don't have the responsibility to disclose these type of things. They're not forced to do them, so I think they have no incentive to do them either. So, and this only wrecks people who buy these coins on exchanges. And the SEC was created for this sole purpose back in the day, to protect people. So how do we even track down these type of deals? Like, if they're going to sell their private private key to some person and pretend that it's unlocked, like, how do we even go through this whole thing?
I mean, I think the only way to do it is by regulating centralized entities. So if these OTC brokers are operating in a certain jurisdictions, you can ask them to be licensed, and then those government agencies that issue the license can do a regular auditing to see whether the licensed brokers are engaging in this type of transactions or not. That's one way. That's how it happens usually in the traditional finance. But I think the challenge with the crypto is that a lot of these cases are, because transaction takes place on chain, where there's no such thing as borders, like national borders. So it becomes really hard for these government agencies to enforce their regulations. So
I guess one way for investors is looking at the on-chain data, actually. So for Mantra, I actually, a couple months ago, I actually heard, like, if you actually look at Mantra on chain, the real circulating supply is extremely low. And actually, as Presto, we kind of did our work, and we can go too deep into details, but we kind of figure out different patterns where it is actually somewhat controlled by few people, we think. So one way to figure out is looking at on-chain data, looking at different wallets, and see how look at abnormal patterns or stuff.
What type of patterns did you see to recognize that it was controlled by a few people?
So I can't really. I mean, I'm also not an expert, so I couldn't go really into details. But we can see that the wallet was just sitting down. Like, they are sitting down. They're not really moving, and it's just some get into the exchanges, and the price. There's a huge price moves, and different stuff that we don't really see on different, I guess, projects.
Okay.
Yeah, so I think I think what we saw was some fund flow into a very small group of addresses. So there's what appeared to be a concentrated ownership that is not very commonly seen in other projects. I think a lot of these are kind of circumstantial reasoning. There's no, cut it like a clear cut, like ways of calling things black and white. But I think just based on like a circumstantial evidences, I think one can reasonably conclude that this, there's a concentration of ownership here. And also, but I think, that's, it doesn't, okay, so that's the ownership part. But I think OTC transaction is something that happens off chain. So on chain data, I wouldn't tell you how many OTC transactions there is for a particular coin.
Yeah. And also, even if it's on chain, like you said, you never know if if these addresses are owned by a certain entity, because they're not labeled. You can just guess by the relationship between those addresses, which makes it really hard for people like me to see what's really going on, because that's the only tool we have. And we can never say, like, if they deny, like, oh, these are not our addresses, like, we've never seen them before. Like, I have no evidence to actually refute that, whatever rebuttal that comes when we just claim something. They can just say, oh, I don't know, then it's game over. So I think that's one problem that we have in this industry right now. I mean, it's a problem. Is it a problem? I don't know, but I think it's a problem. I think Min also agrees that's a type of problem. So the saga was I think the guy, he just landed in Seoul like overnight when the token was dumping, and he actually did like a speech at this conference, and he said, oh, the team never sold. But yeah, it's a sad revelation.
Yeah, I
Hope
mean,
that
I think I listened to that podcast as well, and then he said that his team didn't sell, which is, maybe that's true. Because I don't think he's gonna be lying about that, because it's like the data is on chain. So why, if it, but I think other like VCs and others, he cannot speak for others, right? So maybe it's possible that like large holders away from the actual team was also maybe engaged in OTC transactions, which translate into selling pressure.
Yeah.
Yeah.
And I think this conversation kind of extends to if these projects are actually worth their valuation. Like the Ohm token, it was like, I don't know, it's like almost top 20. It was an almost top 20 token. That would mean it's like probably over a billion FDV. But as long as I remember, the TVL on the chain was like 4 million or so. And nobody really knew what they were doing. Well, they claimed that they were building since 2021, but to be honest, like nobody had a clue. Like everyone was just full of question marks in their head. So yeah, I think that's a conversation for another day. But yeah, we keep seeing these type of mystery projects popping up every day, and yeah, on Twitter recently, there's a lot of criticism on these type of projects. I won't mention who or what accounts are engaging in this drama, but I think this type of criticism and I don't know, pandering and grifting still persists in the industry. And like we discussed earlier, it's a hard problem to fix due to the innate nature of how crypto works. So today, I think we'll have to end the podcast here. Thank you, Peter, Min, for the valuable insights on stablecoins and Ohm, and see y'all later.